As Nigeria's headline inflation retreated for the second time in May, yes, from 18.12% reported in April to 17.93%. The realities in the market in terms of food prices and consumer goods continue to pose challenges to many Nigerians whose disposable incomes have, of course, weakened. From a month-on-month perspective, inflation figures has dropped from inflation accelerated across all parameters, underscoring the fact that inflation remains a major challenge to investors and citizens. The new figure contained in the Consumer Price Index recently released by the National Bureau of Statistics shows that inflation rate dropped by 0.19% to 17.93% in May from 18.12% in April. Experts had predicted a faster inflation rate in May as the major drivers of inflation has remained largely the same, making the figures contradictory to reality. As market sentiments remained upbeat on the Nigerian Exchange Limited, NGX, for the second consecutive week, and as investors continue to position on stocks with attractive dividends yields ahead of half-year 2021 dividends declarations, analysts are of the view that the market should take a cue from the May inflation report as bond yields experience an upward trend. I introduced him earlier. He's the head of retail investments at Chapel Hill, Denham, Mr. Ayodeji Ebo. Mr. Ayodeji, thank you very much and good afternoon. Thank you for your time. Mr. Ebo, if you can hear me, I'm talking about inflation, and it's said to be dropping technically. That's from the figures we see from the NBS for 2 months now. To you,
yes,
is this decline significant, and what's its impact directly with the mood across the economy?
Okay, thanks. And it's very interesting that we've begun to see that moderation, and what we can basically attribute this to is the high base effect. So if we look at the inflation rate is published on a year-on-year basis and on a month-on-month basis. So you look at the month-on-month. Last year May was also around the peak of the lockdown. I think we were on a full lockdown, and prices of food prices went up significantly. So if you look at month-on-month last year, 2020, last year May, you'll discover it was around 1.45% month-on-month, which is very high. So we believe that the moderation that we're seeing within the food segment of the headline inflation can be attributed to not to reduction in terms of prices or reduction in cost of production, but attributed to that high base effect. And secondly, looking at the other portion of the headline inflation, which is core, you would see that rose marginally, and we can attribute that increase that we're seeing to basically the adjustment that we're seeing in the FX market, and also the adjustment at the parallel market. So by and large, we know that in terms of when you look at the environment, especially in May, yes, oil price was high, and that boosted significantly government revenue. And also the vaccination has also helped in terms of that has helped to also tame the spread of COVID, and businesses are also operating as usual. So by and large, that alone is not responsible for the moderation we're seeing, but can only just be attributed to the mathematical calculation, which is the year-on-year effect.
Let me follow up with that. This retreat that we see, do you think it is sustainable? Now, putting side by side, we expect a hike in the price of PMS. Already there's a hike in the price of electricity, or we've already had a little bit of review of that, and I guess there might be a review at any time. We have the multi-year tariff order, we have all of those reviews going on underneath for some segments of our customers. That's on the side. Now, what do you now see? Do you see us sustaining this downward trend with all of these factors I highlighted? Not even looking at the bigger ones.
No, it's not. Those points that you have highlighted, those are the major um, downside risk that may increase inflation. And if they happen, definitely they have that direct transmission to inflation rate. So you spoke about the adjustment. So we're expecting a minor review based on the MITO multi-year tariff order in July. And if that happens, which would impact on energy prices, also for PMS, we've seen oil prices has rose to over $70 per barrel, which, when you look at it, is we look at the impact. We have both the positive and negative impact for Nigeria. So looking at the landing cost has continued to increase. It means someone somewhere is paying for that differential if we don't have that that increase in pump prices. But if we eventually there's an adjustment, if there's an adjustment, and for us the recommendation is a partial adjustment, a gradual adjustment, so that the impact is not felt at once. If that also happens, we would see that major impact on food prices, on transportation, and those major variables have significant impact. We're also seeing another downside risk when you see the FX adjustment, or what we call the depreciation of the FX at the parallel market, currently around 505 naira to $1, where a lot of the informal sector that imports, that's where they also access dollars. That would also impact on prices. So yes, there are very clear downside risk, and once some of these risks crystallize, then we would see that impact, that upward adjustment. But if we like for the electricity, for the PMS, and if we don't see any major adjustment, we may based on the high base effect, we may see that moderation. Then for food, as we go into the harvesting season, yes, we may see that moderation. But around the agricultural sector, insecurity is also a major risk that may fuel high food prices.
Let me ask you this again, Mr. Ayodeji. I want us to talk about the market too very quickly. So I need to quickly move away from, but it's very important that Nigerians get to understand this. President Buhari's speech on Democracy Day, he says the government has tried to lift about 10.5 million people out of poverty. Report from World Bank yesterday says about 7 million people have been moved into poverty line, looking at all that we've seen with inflation and all of that. Where do we really stand in all of this as Nigerians?
So I think the best way to look at it is when you check our population growth rate, it's moving at an average of 3% per annum, and you check our growth rate is moving at we expect the projection is around 1.8% based on World Bank projection, and at least I think for Nigeria we're projecting about 2%. So you would see that no matter how we grow based on this growth rate, we would have more people go into poverty. So would only be able to achieve an inclusive growth that will reduce the rate at which people go into poverty when we're able to grow beyond our population growth rate. So trying to simplify that, it means when you look at the resources that we have, and would continue to have more pressure, the demand will continue to increase because we're unable to produce to match up with that demand, or we're unable to develop to match up with that demand. So I think the answer is really very obvious. As long as we don't grow at a pace where population growth rate is, then we'll continue to have more people go into poverty.
What a good way. Let's now look at things now from investors' angle. Of course, they've not been responding positively to the current economic trends, examining a loss of about 340 billion naira at the exchange. Now, what do you think, or what effect do you think this would have on the market in its entirety? You know what, looking at the current inflationary pressures, this might just not really attract investors to come into the market. How does this come to you?
Okay, I'll look at it from this perspective. So beyond the impact on inflation that would increase cost of quoted companies, but you also look at, for most of those quoted companies, they are also able to, the kind of goods that they produce, they are able to pass the cost to the consumers. Yes, the demand from the consumer's angle will reduce, but when you have some necessity goods, and when you look at the quantity demanded, it's inelastic, then you would see that there will be no major shift in terms of the demand. But also looking at, if we look at it from this angle, where you would see that yields are as high as currently. When you look at within the fixed income market, yields are for the shorter portion of the yield curve, you see that around 9.64%. That's at the last auction. So when you also compare that to the dividend yield, so there's really no major incentive, especially for domestic institutional investors, to come into the market. And you look at the longer end of the curve, you see bond rate around 13-14%. So that is also not encouraging a lot of participation. So what we're seeing more now is we're seeing more of retail participation. We need also the domestic institutional investors to also participate more in especially the PFA in this market, to drive up prices. But talking to the outlook, when you look at the quoted companies, you see looking at it by sector, like the cement industry, we've continued to see that significant growth in terms of their revenue based on the demand for cement. A lot of constructions that have been placed on hold are going, so there are a lot of backlogs that they would have to support, and we've been seeing that positive impact on their results. Coming to the telecommunications sector, yes, we saw that the partial ban on registration of new SIM impacted on their revenue in Q1, but we expect that with the lifting of that is also expected to boost their revenue, especially their voice revenue. But we know that for data revenue will continue to spike. And coming to the banking sector, there's been improvement in yields. We expect that the impairment charges to also moderate because of the business activity that has improved. So we are very bullish on the result of most of these companies in the second quarter. However, because of, if we see any major increase in yields above this current level, that may douse that major upside potential that we may see. But what we would only just pitch is that for investors that have that long-term perspective, you look at some of these stocks. I don't want to give names, but some of them have about 14% dividend yield. So when you buy them at this current level, you know that the return on your investment on a year-on-year basis is around 14%. That's being pessimistic, given that if you assume that the company would maintain the same level of dividend. So beyond the capital appreciation that may also come with it. So there's still very interesting, a lot of sweet spots in the equities market, but it's only good for long-term investors to position now.
Now, havens have been looked out from the money market to treasury bills and bonds markets. We see that movement. Let's start with the opening figures for this week and maturing dates. Take us through that.
Okay, so what we've seen, when you look at within the equities market, we've seen that yields are already capping at a level which it's expected. We know what drove the yields earlier was the movement in OMO rates. So now OMO, for the shorter end of the curve, almost still at 10.1%. So we're seeing yields within the secondary market or the PMA market also at sub 10%. And at the longer end of the curve, we've also seen that we're not seeing that spike, and some days we see some moderation depending on the demand that that some of the instruments experience. But speaking to liquidity has remained very tight, and you would see that interbank rate has been in double digits, and that's what is also responsible for. You would notice that deposit rate in banks have risen significantly to also double digits at some level, depending on the amount they are negotiating. So we believe that as we progress, there may be need that to increase the liquidity in the system, so that the interbank rate will also come down. And for banks, because when you see that yields in risk-free investments is almost at double digits. There's also no incentive for you to want to lend and take further risk. So there will be need to balance. Yet inflation is high. So negative return, we need to maintain a close gap within that space. But we also need to see how we also need to disincentivize the banks from also lending to the real sector.
Now, the Sub-Saharan Africa and Eurobond space open trading with the risk of sentiments. That's as the U.S. Fed meets. Also, news of primary issuance supply from Kenya, debts restructuring from Ethiopia, and Ghana papers the worst hit. Now, how do you think all this performance and all of this will shape Nigeria's performance? That's looking on the continental level.
Yes, I believe that with what we're seeing, where the Fed will be meeting today, and we're expecting that we are not expecting any major shift in terms of the interest rates. But when you look at across the continent, you would see that based on the improvement in terms of perception, so there's been increase in the demand for their instrument, and that has been lowering the yield within that space. And you recall that or you know that Nigeria would also try to see how they want to assess the market based on what they've appropriated in the budget to assess the Eurobond market. So we believe that with high oil revenue or high oil price, that would also give a bit of comfort to some of the investors. But we believe that as we progress, depending on the direction of or the outcome of the U.S. Fed meeting today, we believe that interest rates across the African regions will remain subdued.
Again, let's stay with the pulse of investors this time, particularly as they post half-year reports. What are your thoughts as investors wait with bated breath assessing the next move?
Yes, I think speaking to some of the points I highlighted earlier, investors should, for long-term investors now, should begin to take positions, because we're expecting that the half-year result will be largely positive across different sectors. So I spoke earlier about the industrial sector, about the telecommunication sector, about the banking sector. So we believe that even looking at the fast-moving consumer goods sector, their results too would also be very impressive. If you recall, activities have continued to, that's business activities have continued to expand, and without any major projection. This time earlier in the year, we're expecting there may be any major shutdown again. But with what we are seeing, and also the slow rate of the spread of the COVID-19, especially in Nigeria, so that has continued to fuel demand. Yes, in terms of when you look, consumers' wallet has continued to be very squeezed, but there are some of those items that investors or consumers will continue to feed on or will continue to require. So as a result of that, we believe that there will be that positive impact on the top line of most of the companies. And as a result, looking at half year, if they can perform very positively in the half year, we expect that the second half of the year would also be positive, which means for equity investors, it means that there will be better dividend, and that is especially one area of focus for equity investors.
So back to where we started from. If we are to look at inflation or project ahead with all of the realities on ground, Mr. Ayo, what will be your projections for the next figures for inflation?
Yeah, for us, our projection for the month of June is around 17.65%, and we're looking at inflation tapering around 16% in December. But we've not factored, we decided not to factor, if we did not factor in the shock that we may see from PMS, from the hike in electricity tariff. If we bring that in, then we'll believe that inflation will go back to around the 18-19% levels. Yeah.
All right, it's a good way to leave it there, Mr. Ayodele. But thank you very much for your time. It's great to have you join us on the show. He's the head of retail investments at Chapel Hill, Denham.